when do I sell my silver? When the gold-silver ratio dips below 10 for me. I will start reducing. We're only mining 6.9 on current silver ounces for 1 gold ounce currently. China has reduced the possibility that random people can show up and start sending metals over the board. There's 44 companies already licensed to allow export of silver. We expect a 90.5 run interim target. We expect 333 as a full target, but not the final high. And we expect 4-digit silver in a dollar debasement. Lots of images on X of even just retail Chinese people with the very popular 16 kilogram slabs, which are 500 ounce bars. The rush in demand for delivery and the real surge as the workshop of the world is out east, China, and also, it must be said, Korea. You think of Samsung TVs, devices, etc., that have even gone direct to mines and apparently made investments and secured supply direct to source. That's silver that won't even make it into the exchanges. Silver margins for speculation have jumped twice. It may be worth, I can talk through this. I don't suppose I have to screen share for that, but we're on the 5,000 ounce contracts. The COMEX 5,000 ounce contracts, you are at 20K. They then upped it to 25, and they've now upped the 25 to 32.5. So that's a case of 2 back-to-back increases that have essentially taken you from 20,000 to 32,500 in total. That additional 12,500 is about 62.5% that you've had in quite short succession, in 2 separate moves. So that will have caused a bit of chop. I would argue there's a couple of interesting things going on, and it becomes a question of which is the real market. And my opinion is that the Shanghai is now the real market for silver. It may be worth sharing the differences. There is a premium between the COMEX and the Western world's pricing, all aspects of Western world pricing versus Shanghai. And I would say also that an immense amount of delivery seems to be taking place. That's the other thing that's happened that's driven this, in that there is real...
The margin hikes aren't about volatility control. They're about slowing behavior regulators don't like. COMEX lifting margins by 62.5% in a short window mirrors historical playbooks used during silver squeezes, notably in 2011, when speculative pressure forced intervention. As Francis Hunt points out here, this isn't just about leverage, it's about which market sets the price. Shanghai commanding a premium signals that physical demand, not paper volume, is driving discovery. CME data still shows open interest falling even as prices hold, a sign delivery matters more than speculation. For investors, this widens the credibility gap between futures pricing and physical reality. Next, Francis Hunt explains why this margin pressure may actually strengthen silver's long-term setup.
So here's the difference, in a sense, between gold's performance and silver's performance for me. Gold is the banner for the debasement of debt and fiat. And you've got out of that a catch-up year of 70% because we've been debasing slowly for a lengthy period, and we've actually had gold and silver suppression where it wasn't allowed to catch up. It should have been linear. Every year you lose, you were experiencing 3-5% inflation. You should have had a 5% move in gold and silver. But for decades, it hasn't been like that. So here's the great gift that you're getting. You're getting catch-up moves for suppression error. The difference between gold and silver in terms of their performances is that in the silver markets, it was the ultimate suppression tool, and you had above ground availability that has now largely been far more depleted. And you have real deficits of supply that have existed for multi-years. So in the silver part of the gold market, not only are you getting the inflation debasement trade elements that has driven gold, so you start with the 70% gold has, you've also had, as a loss of trust in the Western system, you've had people saying it now matters more to physically hold and control the actual metal.
This reframes silver's move as math, not mania. Gold's 70% surge reflects years of monetary debasement catching up at once, something CPI data understated for over a decade. Francis Hunt says silver layers that same debasement trade with a structural supply problem. Above ground inventories have been in deficit for 4 straight years, according to the Silver Institute. Hunt's point is critical. Suppression delayed price discovery, creating pent-up upside rather than excess speculation. Investors focusing only on inflation missed the trust breakdown driving physical demand. That's why silver behaves differently than gold at this stage. What Francis Hunt connects next is where this trust gap becomes visible in real-world behavior.
So they have been increased, the increased delivery, mark for delivery component in the futures market has actually seen a massive run in you don't own it unless you hold it physically. So we've had lots of images on X of even just retail Chinese people with the very popular 16 kilogram slabs, which are 500 ounce bars. The largest standard is 1,000 ounce bar. I think I stand corrected that when they say 5,000 ounce, I think it's 5 of the 1,000 ounces is the contract. But I might be incorrect. Someone will correct me below. I'll have to double check that. But anyway, you're having a 2-tier pricing system as well. So the West currently represents, in essence, a discount window for the East. And if you want to follow what direction COMEX silver or your broker in who you're trading with in the silver markets in the Western realm, what's likely to be happening, whether you're going to be going up or down, it's almost more beneficial to be watching the Shanghai price because you get the Asian session and you see what happens there. And the Western market is now following the Eastern market because the delivery market, the most aggressive delivery market, is now in the East. And that's the difference. That's the premium on top of gold.
This is where price charts stop telling the full story. When retail buyers in China accumulate 500 ounce bars, it signals cultural memory kicking in, physical control over paper claims. Francis Hunt highlights a 2-tier system forming, where Western paper markets lag Eastern delivery-driven pricing. Shanghai premiums historically precede global repricing, as seen in copper and nickel during prior supply squeezes. For traders watching COMEX alone, this creates blind spots during Asian hours. Long-term investors should treat Shanghai pricing as a stress indicator, not an arbitrage anomaly. Next, Francis Hunt explains why silver's fundamentals now diverge sharply from gold's.
So silver starts with the 70% monetary metal debasement gains that gold has had as almost a natural, that's what they're all getting as monetary metals. And then on top of that, it's getting the actual shortage, the run on the physical shortage. Gold, less of a shortage aspect because a lot of bullion stored. Central banks hold a lot of it. They can lease it out, lend it, do whatever. But in terms of consumption, silver has consumption. So I think that's the difference between the two, which is the main driver behind your question. How long does silver outperform gold? I also dropped other things in there, like watch the Shanghai price, but I'll hand back to you on that.
I'd love to dive deeper into that differential in the spread between the silver price in the West and that in Shanghai. You mentioned briefly some of the drivers there. Maybe you could get into it in a little more detail and let us know what you're seeing. And would you say that when it comes to Shanghai, it's more of a physical market compared to the paper market of the West? And do you think moving forward more and more into the future, we're going to see the Shanghai price be the one that really reflects the true value of the underlying metal?
Silver's edge isn't hype. It's consumption math Wall Street avoids. Unlike gold, silver gets burned into solar panels, electronics, and industrial supply chains, with demand hitting record highs in 2023. Francis Hunt says central banks can lease gold endlessly, but they can't print silver back into existence once consumed. Hunt's emphasis on Shanghai reflects where real settlement pressure shows first. Western pricing still assumes availability that no longer exists at scale. For portfolios, this means silver volatility isn't a flaw, it's the signal. What Francis Hunt unpacks next challenges who really controls price discovery going forward.
I think any place that is doing actual delivery on the highest level, as always with technical analysis, they'll always say volume is an endorsement. It's like a number of voters for a certain price. If you have a very thinly traded item, I could list a family held company where me and my family members hold 95% of the equity, and we have an IPO with a very minor amount, and we let the market push it around. And at any point, we can whale in and buy up our own remaining 5%, or we can dump it. That changes the entire market cap valuation, including for the 95%. So we'll always say to you, volume, true volume is an endorsement for the price. Thin volume is not necessarily as strong an endorsement on the price. So in the case of silver, I'll say where the bulk of the delivery is taking place. That said, it would not be accurate to just say that COMEX and LBM are just paper markets, because what's actually happening is delivery is being called for there too. But you do still have this premium. It's worth possibly showing that. So this is the Chinese contract adjusted from Chinese yuan to dollars and adjusted to ounces from kilograms. That AG, this formula you see up here.
This quietly dismantles the idea that price alone tells you where real demand lives. As Francis Hunt points out here, volume tied to delivery matters more than traded contracts because thin markets can be steered with surprisingly little capital. This is exactly what history shows in commodities. From silver in 2011 to nickel in 2022, where leverage masked true demand until delivery stress exposed it. COMEX and LBMA still see deliveries, but the persistent Shanghai premium signals where conviction is deepest. For investors, this reframes risk. Price stability without volume is fragile, not safe. What Francis Hunt shows next explains how that premium becomes visible on the charts.
So I'm talking up top here. AG1 with the interrogation mark is the front end contract on the futures market. That is the USD to the Chinese yuan adjustment, because obviously in Shanghai it's in yuan. And so there's a currency rate in that. And then that 32.150747 is me being a little bit OCD to the umpteenth degree on the conversion of kilograms to ounces. So metric system to the accepted. So this brings this chart over here to being the leading chart, I think, for silver prices. I'm on the 1 hour mainly because I'm just trying to show you the events of recent, because many people that are regular watchers and viewers, they know already that you and this channel have been suggesting everybody should be bullish, the silver market, and they're all wondering what do we make maybe of the recent events with the price. The one on the left here is your US stroke Western world pricing. Let's go with a different color. And it's just your standard silver market. And you can see technically you this dipped a tiny bit lower. Let's just see. We had a dip down over here. You can see they're trading at different prices, first of all, and there's a premium in the East.
This is a reminder that currency translation can quietly change the entire narrative. Adjusting Shanghai silver into dollars exposes something Western charts hide. Price leadership doesn't always come from New York or London. Francis Hunt's comparison shows the Eastern market holding firmer even as Western prices dip, a classic sign of underlying demand absorbing supply. Similar divergences appeared in energy markets during 2020-2021 before prices repriced globally. For investors, this means short-term pullbacks may be technical noise rather than trend breaks. Next, Francis Hunt explains why arbitrage hasn't erased this gap yet.
So you've got a roughly around 76 at the moment in Shanghai on the formulaic adjustment. Now, I'd imagine markets being relatively efficient, that $4.30 is probably what you would lose if you bought took delivery in the West at one of the standard areas and shipped in volume, you'd probably have a very marginal profit or a marginal loss. The markets are kind of quite efficient like that. So the West still gets to trade cheaper for now because there's a frictional cost to have it made available, Western delivered silver made available to, say the East, someone in China. So they'll keep buying locally where it's just a case of you get it delivered at 76, because to buy at 71, 78, as we are here, by the time you've done everything else, you'd need to have a large amount of scale, and you'd probably barely be worth it, and a lot of extra hassle. So that's the premium difference for arbitraging the different markets. These are frictional. But what you'll notice is that if I just tidy up, we traded lower over here, and we took out that low on the Chinese market. But by the time the Western market opened and it was trading down, the Chinese market started to trade back up towards that. So we got a floor in a little bit earlier, and we've been maintaining that premium. Also bearing in mind they have different trading hours.
This is where efficiency myths collide with real-world logistics. The $4 to $5 premium isn't a free lunch. Shipping, insurance, and settlement costs erase easy arbitrage, keeping markets segmented. Francis Hunt highlights an important signal: Shanghai finding a price floor before Western markets, suggesting stronger marginal buyers. This mirrors how Asian physical demand supported gold during Western sell-offs in 2022. For portfolios, it means volatility in paper markets may not reflect weakening fundamentals. Next, Francis Hunt explains why this premium may persist longer than expected.
So sometimes one is not available and then the other one drifts on its own. But I'd start to suggest that this formula might be closer to your true market, and then you have to have a feel for the percentage differential. If we were to take it at current values, you're around 76 and 71.72. So if you make it about, it looks like about 6%. If it was 10%, it would be about $7 on 71. That would take you to 78. So I think you're around 6 or 7%. That's sort of not quite worth it, arbitrage frictional cost. But at some point, in truth, these should be very similar. But the difference is the rush in demand for delivery and the real surge, as the workshop of the world, is out east, China, and also, it must be said, Korea. You think of Samsung TVs, devices, etc., that have even gone direct to mines and apparently made investments and secured supply direct to source. That's silver that won't even make it into the exchanges because it will be provided direct to manufacture. That's going to have a knock-on effect on supply as well. So that's the two stories. If I'm just sharing the chart, I'll also, while we've just got the share screen up, just show you that margin changes, which I think would have just reduced some of the retail further.
This exposes the part of supply the market never gets to price. When manufacturers secure silver directly from mines, the metal disappears from exchange inventories entirely, tightening availability without headline shortages. Francis Hunt connects this to rising Asian industrial demand, especially from China and Korea, where solar and electronics consumption keeps accelerating. The Silver Institute notes industrial demand hit record highs recently, yet futures pricing still assumes liquidity. For investors, this creates hidden scarcity risk that only shows up later, usually violently. Next, Francis Hunt ties this supply squeeze back to margin changes and market control.
We had current initial margin at 25. That's on the COMEX 5,000 silver futures contract. Current maintenance, and then the new initial maintenance is now 32.5. And it wasn't that long ago, it was barely a week, that you were moving from 20 to 25. So you've effectively, in quite short duration. This is at their discretion, and of course they'll want to tame the market. Many people see them as co-conspirators with the banking cartel in terms of the suppression of silver markets. So they don't want any speculators getting hot and rich on a bank that's heftily short. There's been quite a few rumors that there were banks unable to deliver. A bank, many banks, one bank, who knows, or maybe just a rumor that doesn't have any validation behind it. So they took some of the sting out on the thin markets with these margin, but nothing on the big picture in terms of what we expect. We expect a 90.5 run as a interim target. We expect 333 as a full target, but not the final high. And we expect 4-digit silver in a dollar debasement, a chronic era, where the gold-silver ratio will be heading towards single digits between each other. So in terms of everything we've spoken of before, Jesse, no changes there.
I wonder what your thoughts are when it comes to China exporting or restricting the export of silver.
The quiet story here isn't volatility, it's control. Raising COMEX initial margin from 20 to 32.5 in barely over a week is not risk management. It's a circuit breaker aimed directly at leveraged speculators. History shows this playbook clearly. Margin hikes hit silver hard in 1980 and again in 2011. Both times halting momentum when banks were most exposed. As Francis Hunt and others have documented, silver remains one of the most heavily shorted commodities by commercial banks. The targets cited sound extreme, but the mechanism is familiar. Suppress price discovery during thin liquidity, not because demand vanished, but because leverage became inconvenient. What Francis Hunt says next matters because policy, not charts, decides timing.
Now, guys, there's a lot of misinformation circulating on X. People are posting that China has banned the export of silver. That is not correct. There are certain restrictions. There needs to be state-approved companies. They have to go through a process. So what that means is there will be less silver coming out of China, not no silver. But Francis, I wonder what your take is there and just the whole geopolitical picture when it comes to the silver market, because we've also seen the U.S. declare silver a critical mineral. India is doing some very interesting things when it comes to the silver market as well. When we look at the world and kind of an awakening that seems to be occurring among governments and companies, we saw Elon Musk chime in about silver on X, being concerned about its cost going up for industry. How do you see that global picture when it comes to silver and this kind of great awakening that might be occurring?
It's a very good point you make. I mean, I've retweeted about the China export thing, but there's a qualification in that I didn't put in the tweet myself. And that is there's 44 companies already licensed to allow export of silver who are recognized merchants for some or other commercial reason that can export regardless.
This isn't a ban, it's a bottleneck. And bottlenecks move prices quietly before headlines catch up. Francis Hunt says China limiting exports to 44 licensed firms reduces supply flexibility, not availability, which matters more during demand spikes. Combine that with the US designating silver a critical mineral in 2023 and India's rising imports. And you have governments treating silver as strategic infrastructure, not a commodity. Elon Musk flagging silver costs isn't casual commentary. Tesla and solar supply chains are silver intensive. According to the Silver Institute, industrial demand hit a record in 2024. Markets misprice slow constraints first. Next, Francis Hunt shows how control tightens without ever saying ban.
What is probable, though, is China has reduced the possibility that random people can show up and start sending metals over the board. And they said there's only 44 companies that can export. We want them registered. We want to know who they are. And at any given moment, they could say nothing for this week or nothing for next week for whatever reason. And those people who would want to retain their license would absolutely comply, or they'd find themselves shut down. So it's more about grabbing the reins and the ropes, and what's in our country is staying in our country. What really needs to go out for a valid reason can go out, but we get to know every single ounce and who's doing it, and they have to report to us the amounts, and we'll be controlling that. So it's more a step in that direction than complete export ban in the absolute sense.
This is resource nationalism wearing a bureaucratic mask. China isn't stopping exports, is making them conditional, reversible, and traceable. which gives policymakers leverage at moments of stress. That matters because silver inventories are already tight. LBMA reported declining vault stocks through 2024, while industrial demand climbed. Control over every single ounce allows silent throttling without market panic. For investors, this raises geopolitical risk premiums that never show up in CPI. As Francis Hunt often notes, control precedes repricing. Next, he ties this supply grip directly to portfolio exit strategy.
I don't know. I can't predict the future, but my suspicion is you end up at sub 1 ounces. 0.66 is my guess, will buy you the full Dow. That's when you sell your gold. For those that want to know, when do I sell my gold? When do I sell my silver? When the gold-silver ratio dips below 10 for me. I will start reducing. By the way, we're only mining 6.9 on current silver ounces for 1 gold ounce currently. So, and you can overshoot. So you could go 3 silver ounces to get your gold. You could. I'm not saying you will, but single digits, even though it sounds very aggressive, I think it's quite logical that it has a decent chance of doing at minimum that and possibly more. So there's your sell point for silver. You rotate into gold when you're there, and your gold rotation into equities again, they are going to have headlines, equities are dead, because you're going to have equities go down in nominal terms. Remember, you asked equity markets gone up. I'm saying it hasn't gone up, not by my basis of accounts. You've just had 4 bad years. 1, 2, 3, 4. Because my default investment is gold ounces. The only thing that's giving me alpha over my gold ounces are silver, platinum, and potentially miners on top of that. Everything else is losing value. We are in debasement because the basis of account is no longer reliable.
This isn't a price call. It's a framework for measuring reality. Using gold ounces instead of dollars exposes the illusion. Equities look flat or down over 4 years when priced in hard assets. Historically, the gold-silver ratio averaged near 15. Sub-10 levels only appear during monetary extremes like 1980. Mining ratios near 7 to 1 highlight structural imbalance, not speculation. The rotation logic matters more than the numbers. Metals to equities only after real value resets. As Francis Hunt emphasizes, nominal gains mean nothing in debasement cycles. What comes next challenges how most investors define profit.